Today we will talk about default. When a mortgage borrower defaults, not only the borrower but also the lender are financially affected. On the one hand, we have transaction costs to both sides, mostly legal costs. Also, the borrower suffers a credit rating downgrade that somehow harms his possibilities to take new financings, new credits in the future. The lender loses part of the principal, etc. In this presentation, we will discuss the possible different courses of action in case of default. As we know, default occurs when the borrower stops paying the mortgage. In case of default, there are basically three possible courses of action. Either you sell the property, or foreclosure, meaning that the lender takes possession of the property, or the loan is refinanced, giving more possibilities to the borrower to pay the loan in the future. All of these alternatives are costly to both sides. Let's analyze them in more detail. First, selling the property. The convenience of selling the property depends on how its market value compares with the mortgage balance. If the property price is larger than the mortgage balance, the best option is often for the borrower to sell. Of course, the borrower sells the property, takes part of the money that he recovers, and with this part of the money pays the loan. However, if the property price is smaller than the mortgage balance, then usually the two usual courses of action are either foreclosure or refinancing. Let's analyze these two possibilities. Foreclosures. Well, foreclosures take a long time, usually at least 1 year, and cost the lender a percent of property value. This is because, given that the process takes so long, during this period of time, the property usually is badly maintained and loses value. On the other hand, refinancing implies lengthening the maturity of the loan, lowering the interest rate, changing the payment profile, or any combination of these possibilities. All of these measures generally are costly to the lender. On the other hand, refinances are becoming less popular among financial institutions, basically because of evidence from the United States that tells us that restructured loans, meaning loans which have been refinanced, have a high probability of default. So, in general, down the road, they default again. And also, those loans which are not refinanced, usually if the bank gives more time to the borrower to pay, usually about 1/3 of the delinquent borrowers in the end catch up with their payments within a year. So what we can conclude here? First, both foreclosure and refinancing are costly to both parties, lender and borrower. If the value of the property is below the mortgage balance, one of these two alternatives is adopted, depending on their cost and the negotiating power of the parties. Generally, of course, the negotiating power is on the side of the lender, which is the bank. In our next video, we will illustrate how to select between these two alternatives, either foreclosure or refinancing, and we will also introduce an innovative refinancing arrangement where, under certain conditions, both sides, borrower and lender, might be better off. And that's everything I wanted to share with you in this opportunity.